Earlier this week, Trump just ordered a blockade on Venezuelan oil tankers. And some of us may overlook this opportunity because we are so focused on the AI bubble right now. Look, if you're short on time or you don't want to hear some random guy ramble about boring things such as the oil industry, the safest plays here are still Exxon and Chevron. They benefit from crude risk premiums without the volatility whiplash. Bookmark that, come back later if you want. But if you want to understand why and maybe explore a more speculative angle the mainstream isn't covering, stick around for around 10 minutes. Hey, I'm DataCat. For those who are new here, which is probably most of you since this channel's only about 5 months old, I used to be an analyst at a Fortune 50 company. You know, the whole corporate grind thing, spreadsheets, meetings about meetings, the usual. Now I've traded that for lasers and keyboards, and a cat, or maybe cats, obviously. So my background is more fintech than pure commodities or a self-proclaimed trading guru, I'll be honest. But here's the thing, business operations share common patterns. And when something like this Venezuela situation drops, I think it's worth walking through together. I'm learning too. If you know more about tanker shipping than I do, drop it in the comments. Seriously, I'm not above being corrected by someone smarter. That's like 90% of the internet anyway. If you're into this kind of things, please smash that like and subscribe button so that my cat won't kick me out of the house. Alright, let's get into what's actually happening. So President Trump announced ordering what he called a total and complete blockade of US-sanctioned oil tankers going into and out of Venezuela. This follows the seizure of a tanker tied to sanctioned oil flows. Basically, the US is squeezing Maduro's oil revenue streams. Now, here's what most coverage isn't clarifying well. The operational and legal contours of this are still unclear. CNN, Reuters, they all note this. Is this enforcement narrowly targeted at already sanctioned vessels? Or does it expand to more interdictions, broader definitions, pressure on insurers and banks? That distinction matters, like, a lot. Because if it stays narrow, we're talking maybe 300,000 barrels per day threatened. If it goes full embargo, estimates say triple that amount, adding roughly $2 to $3 per barrel to crude prices. But, and this is important, the market is currently well supplied. So this is more likely to produce short bursts of volatility, headline squeezes and freight repricing rather than some sustained oil super spike, unless enforcement broadens materially. Think of it like this, the cat knocked a glass off the table again. Everyone's nervous, but this time the glass hasn't shattered yet. We're watching to see if it rolls off the edge or someone catches it. Reuters reported that PDVSA, that's Venezuela's state oil company, faced cargo disruptions. Counterparties started demanding steeper discounts. Their merry crude, discounts to China widened to as much as $21 per barrel below Brent. $21! That's not a typo. So the first order effect isn't that Venezuelan barrels disappear from the world. It's that Venezuela gets paid less and has a harder time moving those barrels. The friction goes up, the margins go down. For Maduro, this is painful. For the global oil market, it's noise, at least for now. Okay, here's something most retail investors completely miss when these sanctions stories break. The shadow fleet. According to Tanker Tracker's data cited by Reuters, there are over 80 vessels loaded or waiting near Venezuela right now. More than 30 of those are under US sanctions. But zoom out further. The global shadow fleet. These are tankers operating in gray or sanctioned trade flows. Includes around 1,423 tankers total. Over 60% of those are subject to US, UK or EU sanctions. And here's the number that matters for tanker investors. Frontline, one of the biggest tanker operators, estimates that roughly 15% of the global VLCC fleet has been hit with sanctions. So why does this matter? Because if enforcement pressure makes sanctioned tonnage unusable or too risky, compliant tanker owners, the ones playing by the rules, see tighter availability. Supply shrinks, rates can spike. But, and this is the two-sided setup most people don't think about. If enforcement reduces lifted barrels overall, meaning fewer barrels a moving period, that cuts tanker demand too. So it's not a one-way trade, it's conditional, like a cat deciding whether to knock something off your desk. Could go either way, depends on the mood. Alright, if you just want exposure to this event without living on shipping headlines every day, the cleanest large cap expressions remain as ExxonMobil or Chevron. Why these two? They're liquid, diversified, and they tend to benefit from crude risk premiums and any supply tightening narrative without the operational whiplash that tanker equities can experience. This is the I want to sleep at night option. And honestly, for most people, this is probably the right answer. I'm not here to pump anything speculative. These are the blue chips. Now, for those who want to understand a more speculative name, and I want to be clear, this is not a recommendation. This is an educational walkthrough. Let's look at Frontline, ticker FRO. I picked FRO as an example because it's one of the larger tanker operators, and frankly their financials and charts looked okay-ish to me. Not amazing, okay-ish. If you're more familiar with this industry, there are peers worth researching too. Share them in the comments if you've got better ideas. Frontline is essentially a macro plus freight rate instrument. They operate a large fleet of tankers with meaningful spot exposure, meaning their earnings are highly sensitive to whatever the current shipping rates are. In Q3 2025, they reported a beat in revenue and declared a dividend of 19 cents per share. Now, that might sound modest, but tanker dividends are cycle dependent. They can look huge in a good tape and compress quickly when rates roll over. And here's the thesis link. If the crackdown makes shadow fleet operations harder, some trade may reroute, become longer, or require more compliant tonnage. That's a potential tailwind for VLCC and Suezmax utilization and rates. But then there's always a but. If the crackdown mostly shrinks Venezuelan exports, meaning fewer barrels moving at all, tanker demand could weaken. That's a headwind. So Frontline is a second-order beneficiary. It pays off when the world gets messier in a way that increases tanker demand or removes effective supply. It's not a direct bet on Venezuela. It's a bet on chaos having a particular shape. And if Trump means chaos to you, well then, you know what I mean. Kind of like how my cat benefits when I'm distracted. More opportunities to steal food off my plate. Alright, let me walk through the chart for those who care about technicals. Quick price and trend context. Last close was $22.93. That's below both the 20-day EMA and 50-day SMA. So the near-term trend is still soft. However, it's above the 200-day SMA at 1964, and there's a golden cross active. So the longer-term uptrend regime is technically still intact. We're in a pullback inside that regime. In terms of momentum, RSI last reading was 44.1, recovering from around 39 the day prior. That's mild momentum improvement, not hot. Stochastics, K around 16.5, D around 14.1, that's oversold-ish territory. On the other hand, MACD histogram is negative but rising, suggesting downside momentum might be easing. And on Wednesday we saw a gap and fade, often reads as buyers defended the lows but didn't follow through yet. It's not a confirmed reversal, it's a pause. And the immediate support cluster is around 2270 now. Next support below that would be 2120. Nearby resistance are the 20-day EMA at 2340, then the 50-day SMA around 2370. Bigger resistance band are 2430 to 2460, then up to 2520 through 26. And one-way traders might frame this. Obviously not financial advice. A bull case confirmation would typically be a reclaim of 2310, then the 20-day EMA, and holding above 2370. Bear case confirmation would be losing that 2270 support cluster, which opens a move toward 2120. And if you're considering this kind of speculative name, here's what you'd want to watch. First, positive catalysts. 1. More seizures or stricter enforcement specifically against sanctioned tonnage that tightens effective supply. Reuters described many sanctioned vessels at risk with operators reconsidering sailing. 2. Evidence that Venezuelan barrels continue moving but via longer routes or more compliant logistics, not simply disappearing. That's ton-mile positive for tanker owners. 3. Observable improvement in tanker market pricing. VLCC and Suezmax spot benchmarks translating into higher time charter equivalents. That's the fundamental driver of FRO's cash flow and dividends. Then, here comes 2 negative catalysts. De-escalation or non-enforcement that removes the risk premium entirely, or a regime where Venezuelan exports fall enough that overall tanker demand declines. So look, this video wasn't about pumping some obscure stock. The bigger names like Chevron and Exxon remain, in my view, the better investment choices for most people. But under current circumstances, some might want to diversify a little into more speculative names. FRO's financials and charts seem okay-ish, not great, okay-ish. If you know peers in this space better than I do, genuinely share them below. I'm here to learn too. That's all I've got. If this was useful, consider pressing the like button and subscribe. The algorithm apparently likes that. And so does my cat. More subscribers means more treats. For him, not me. Although, now that I think about it. Anyway, thanks for watching. DataCat out. Stay safe and stay sharp, and I'll see you in the next one.